You need to understand something that's happening right now in the metals market, something that most people aren't paying attention to, and by the time they do, it's going to be too late. The global supply of critical metals is disappearing, not slowly, not gradually, right now, and the implications of this are staggering. Let me show you what I'm talking about. Copper prices just hit record highs. They've rallied over 20% since the start of this year. But here's what's really happening beneath the surface. The International Energy Agency just released a warning that should send chills down your spine. They're projecting a 30% supply deficit by 2035. 30%. That's not a small gap. That's a structural crisis. And copper isn't alone. Lithium, nickel, cobalt, rare earth elements. The entire suite of metals that power our modern world is facing the same problem. Supply is drying up while demand is exploding. Think about what that means for a second. Every electric vehicle needs about 180 pounds of copper. Every wind turbine requires thousands of pounds. Data centers, AI infrastructure, the electrical grid modernization everyone's talking about. All of it requires massive amounts of these metals, and we don't have them. Let me paint you a picture of how we got here. For decades, mining companies operated on a simple principle. Find deposits, extract them, sell them. The cycle worked because demand was predictable, steady, manageable. But something changed. The energy transition happened faster than anyone anticipated. Governments around the world committed to net zero targets. Electric vehicle adoption accelerated. Renewable energy installations skyrocketed. And suddenly the demand curve went vertical. Here's the problem. You can't just turn on a copper mine like flipping a light switch. The average time from discovery to production is 16 years. 16 years. And that's if everything goes perfectly. No permitting delays, no environmental challenges, no community opposition, no technical problems. In reality, it takes longer. So while demand has been doubling and tripling, supply has been stuck. Mining companies haven't been investing in new projects because for years, metal prices were depressed. Why would you spend billions developing a mine when prices barely covered your costs? They didn't. And now we're paying the price. Let me show you what's happening in the copper market specifically, because copper is the canary in the coal mine here. It's the most critical metal for electrification. You can't build the future without it. Goldman Sachs just released their forecast. They're calling for continued elevated prices. But here's what they're not saying loudly enough. The supply deficit isn't temporary. It's structural, meaning it's baked into the system for years to come. Chinese demand for refined copper fell 8% year over year in the fourth quarter. You'd think that would ease prices, right? Wrong. Prices are still at record highs. Why? Because even with Chinese demand falling, global supply is so tight that it doesn't matter. Think about that. One of the world's largest consumers is buying less and prices are still skyrocketing. That tells you everything you need to know about how severe this shortage really is. And it's not just about new mines not coming online. Existing mines are facing disruptions, labor strikes, equipment failures, grade decline. When you've been mining a deposit for decades, the easy ore is gone. What's left is harder to extract, more expensive to process, and yields less metal per ton. The mining industry calls this grade decline, and it's happening everywhere. I was looking at data from major copper producers. Their average ore grades have fallen by 30% over the past 15 years. That means they have to move 3 times as much rock to get the same amount of copper. More energy, more equipment, more cost, and ultimately less supply. Now let's talk about what's happening with the other critical metals because this story gets even more concerning. Lithium, the metal that powers every battery in every electric vehicle. Prices crashed in the past couple years because of oversupply from new mines in Australia and South America. Everyone thought the lithium shortage was over. They were wrong. What happened was a classic boom-bust cycle. Prices spiked, companies rushed to develop new projects, supply flooded the market, prices crashed. But here's what people missed. Demand never stopped growing. It just grew slower than the temporary supply surge. Now that supply surge is ending. Many of those new lithium projects were marginal. They only made economic sense at high prices. When prices crashed, they became unprofitable. Some shut down. Others delayed expansion plans. And meanwhile, demand kept climbing. The International Energy Agency's latest outlook shows lithium demand growing by 400% by 2040, 4 times current levels. And we're already seeing supply constraints reemerging. Battery manufacturers are getting nervous. They're signing long-term supply contracts at premium prices. They're investing directly in mining projects. Some are even buying mines outright. That's not normal behavior. That's what you do when you're terrified about securing supply. Then there's nickel, another critical battery metal. Indonesia dominates global supply, producing over 50% of the world's nickel, and they've been flooding the market with cheap nickel from their massive laterite deposits. But there's a problem. Most of that Indonesian nickel isn't suitable for batteries. It's the wrong type. Battery manufacturers need high-purity nickel sulfate. Most of Indonesia's production is nickel pig iron, which is used for stainless steel. So even though global nickel supply looks adequate on paper, the supply of battery-grade nickel is extremely tight, and building the processing facilities to convert lower-grade nickel into battery-grade material takes years and billions of dollars in investment. The market is starting to figure this out. Nickel prices have been volatile, but the premium for battery-grade material keeps widening. That's your signal that the shortage is real. Cobalt is even more concerning. About 70% of global cobalt production comes from the Democratic Republic of Congo. One country. And much of that production comes from artisanal mines with serious ethical and environmental issues. Battery manufacturers have been trying to reduce cobalt content in their batteries because of these concerns, and they've made progress, but you can't eliminate it entirely, not with current technology. You still need cobalt for battery stability and longevity. So what happens when demand for batteries grows by 500%, but you can't significantly increase cobalt supply because it's geographically concentrated in a politically unstable region with limited infrastructure? You get a crisis. And then there are the rare earth elements. These aren't actually rare in terms of geological abundance. They're rare because they're difficult and expensive to extract and process. And China controls about 90% of global processing capacity. Think about that for a second. 90%. One country controls the processing of materials that are essential for everything from electric vehicle motors to wind turbines to military equipment. The United States and Europe have been trying to build domestic rare earth processing capacity for years. It's not going well. The environmental regulations are strict, the technology is complex, the economics are challenging, and China has decades of experience and economies of scale that are hard to compete with. So we're dependent on a single country for materials that are critical to our economic and national security. And that country has already demonstrated willingness to use rare earth exports as a geopolitical weapon. Now, let me connect this to something that affects you directly: your retirement, your savings, your financial security. Because here's what most people don't understand. When critical materials become scarce, it doesn't just affect the industries that use them. It affects everything: inflation, economic growth, geopolitical stability, the value of your currency. If you're sitting on retirement savings in traditional assets, you need to understand how this metals crisis could impact your wealth. Because when supply chains break down and inflation accelerates, paper assets lose purchasing power fast. I put together a comprehensive guide on how to protect retirement wealth during periods of resource scarcity and inflation. It covers strategies that have worked historically when commodity shortages drove economic instability. You'll find it in the description below. If you have significant retirement savings, it's worth reviewing. Now, back to the crisis at hand. Let's talk about what happens next. Because understanding the trajectory of this shortage is critical to understanding how it affects markets, economies, and your personal finances. The first thing you need to know is that this isn't a problem that gets solved quickly. Even if mining companies started investing heavily in new projects today, those projects wouldn't produce metal for a decade or more. And they're not investing heavily. Why? Because the last commodity boom-bust cycle burned them badly. Shareholders are demanding capital discipline. They want dividends and buybacks, not risky long-term investments in new mines. So you have this fundamental mismatch. Demand is growing exponentially. Supply is growing linearly at best, and the gap between them is widening every year. What does that mean for prices? They go up, a lot, and they stay up. But it's not just about prices. It's about availability. At some point, price becomes irrelevant if you simply can't get the material you need. And that's where we're heading with several of these critical metals. Imagine you're an electric vehicle manufacturer. You've invested billions in factory capacity. You've taken deposits from customers. You've made commitments to dealers, and then you can't get enough battery-grade nickel to build the batteries you need. What do? You pay whatever it takes. You sign long-term contracts at premium prices. You invest in mines. You lobby governments for support. You do whatever is necessary to secure supply. And that's exactly what's happening right now. The scramble for critical metals has begun. Most people just don't see it yet because it's happening in boardrooms and supply chain negotiations, not on the evening news. But the effects are starting to show up. Electric vehicle prices aren't falling as fast as everyone predicted. Why? Because battery costs aren't falling. They're rising, because the metals that go into batteries are getting more expensive and harder to source. Renewable energy projects are facing delays, not because of permitting or financing, because they can't get the materials they need. Copper for wiring, steel for structures, rare earths for generators. The energy transition everyone's talking about, it's running into a hard physical constraint. We don't have enough stuff to build it. And here's where it gets really interesting. Governments are starting to panic. They're realizing that their climate goals, their economic plans, their national security strategies all depend on access to materials they don't control. So what are they doing? They're stockpiling. They're subsidizing domestic mining. They're forming strategic partnerships with resource-rich countries. They're invoking national security provisions to restrict exports. In other words, they're treating critical metals the way they used to treat oil, as strategic resources that are too important to leave to market forces alone. The United States just passed the Inflation Reduction Act, which includes massive subsidies for domestic battery production and critical mineral processing. The European Union has its Critical Raw Materials Act. China has been securing supply chains for years through its Belt and Road Initiative. This is economic warfare by another name, and the battlefield is the global metals market. Now let me tell you about something that's not getting enough attention. The recycling problem. Everyone talks about recycling as the solution to metal shortages. And yes, recycling will play a role. But it's not the silver bullet people think it is. First, you can only recycle what's already been produced. And most of the products that contain these critical metals are still in use. Electric vehicles have a lifespan of 10 to 15 years. Wind turbines last 20 to 25 years. You can't recycle them until they reach end of life. So even with perfect recycling, you're looking at a decade or more before recycled supply becomes significant. Second, recycling isn't 100% efficient. You lose material in the process. And some metals are extremely difficult to recycle economically. Rare earth elements, for example. They're used in such small quantities and mixed with so many other materials that extracting them from end-of-life products is technically challenging and expensive. Third, recycling capacity takes time to build. You need collection systems, processing facilities, technology development, regulatory frameworks. None of that happens overnight. So yes, recycling will help, but it's not going to solve the supply crisis we're facing in the near term. We're still going to need massive amounts of newly mined material. And that brings us back to the fundamental problem. We're not mining enough. We're not investing enough in new projects. And the projects we are developing are taking longer and costing more than ever before. Let me give you a specific example. There's a copper project in Alaska called Pebble Mine. It's one of the largest undeveloped copper deposits in the world. It's been in the permitting process for over a decade, and it still doesn't have approval to proceed. Why? Environmental concerns, community opposition, regulatory complexity, all legitimate issues that need to be addressed. But the result is that billions of pounds of copper that the world desperately needs remain in the ground. And Pebble isn't unique. There are dozens of projects around the world facing similar challenges. The gap between when we need the metal and when we can actually produce it is growing wider. Now let's talk about what this means for inflation. Because this is where the metals crisis connects directly to your wallet. When critical materials become scarce, their prices rise. That's basic economics. But the effects ripple through the entire economy. Because these materials are inputs into everything. Higher copper prices mean higher costs for construction, for electrical equipment, for consumer electronics. Higher lithium prices mean higher costs for batteries, which means higher costs for electric vehicles and energy storage systems. Higher steel and aluminum prices mean higher costs for manufacturing, for transportation, for infrastructure. And all of those higher costs get passed on to consumers. That's inflation, not the temporary kind that central banks can control with interest rates. The structural kind that comes from real physical shortages. This is the type of inflation we saw in the 1970s when oil became scarce. Prices went up and stayed up because the underlying supply problem couldn't be solved quickly. And here's the scary part. The metals crisis is potentially worse than the oil crisis was, because at least with oil, you could drill more wells relatively quickly. With metals, you're talking about decade-long development timelines. Central banks are going to struggle with this. They can raise interest rates to slow demand. but they can't create new copper mines or lithium deposits. The supply constraint is real and physical, not financial. So what does that mean for your savings? It means that holding cash or bonds during a period of structural commodity inflation is a losing strategy. The purchasing power of those assets erodes as prices rise. Historically, during periods of commodity-driven inflation, hard assets have been the best protection. Real estate, commodities themselves, and precious metals. Gold and silver have been monetary metals for thousands of years precisely because they hold value when paper currencies lose purchasing power. They're no one's liability. They can't be printed or created out of thin air, and they're universally recognized as stores of value. When the global metals crisis drives inflation higher and currencies weaker, precious metals tend to perform extremely well. We saw it in the 1970s, we saw it in the 2000s, and we're likely to see it again. But here's what most people miss. It's not just about gold and silver prices going up. It's about preserving purchasing power. It's about having assets that maintain their value when everything else is getting more expensive. Let me tell you a story that illustrates this point. In 1971, when the United States went off the gold standard, gold was $35 an ounce. A new car cost about $3,500. So 100 ounces of gold could buy you a car. Today, gold is over $2,600 an ounce. A new car costs about $48,000. So guess what? 100 ounces of gold still buys you a car. Actually, it buys you more than a car. That's what preservation of purchasing power looks like. The dollar lost over 95% of its value during that period, but gold maintained its purchasing power. And we're entering another period where currencies are likely to lose value, not because of monetary policy mistakes, although those don't help, but because of real physical constraints in the supply of materials that our economy depends on. When you can't get enough copper to build infrastructure, when you can't get enough lithium to build batteries, when you can't get enough rare earths to build motors, the economy slows down. Productivity suffers, and the currency that represents claims on that economy loses value. This is why central banks around the world have been accumulating gold at record rates. They understand what's coming. They're preparing for a world where commodity scarcity drives inflation and currency instability. In the past 2 years, central banks have purchased over 2,000 tons of gold. That's the highest level of buying in over 50 years. And it's not just traditional gold buyers like Russia and China. It's countries like Poland, Singapore, and India. Countries that are looking at the global economic landscape and deciding they need more hard assets on their balance sheets. They're not doing this because they think gold is going to go up 10% or 20%. They're doing this because they're worried about the stability of the entire financial system in a world of resource scarcity and geopolitical tension. And if central banks are worried, you should be too. Now, let me bring this back to the immediate situation. The metals crisis isn't some distant future problem. It's happening right now. Prices are rising. Supply chains are tightening. Companies are scrambling to secure materials. And it's going to get worse before it gets better. The energy transition is accelerating. Electric vehicle sales are growing. Renewable energy installations are expanding. Data center construction is booming. All of these trends require massive amounts of metals. At the same time, mining supply is constrained. New projects are delayed. Existing mines are facing challenges. And geopolitical tensions are disrupting trade flows. The gap between supply and demand is widening. And that gap translates directly into higher prices, supply disruptions, and economic instability. For investors, this creates both risks and opportunities. The risk is that traditional portfolios get hammered by inflation and economic disruption. The opportunity is that positioning in hard assets and commodity-related investments could provide significant protection and returns. But you have to act before the crisis becomes obvious to everyone, because once it's obvious, asset prices will have already adjusted. The time to position for a crisis is before it fully unfolds, not after. Think about what happened with oil in the 1970s. By the time everyone understood that oil scarcity was a structural problem, prices had already gone up tenfold. The people who protected their wealth were the ones who saw it coming and positioned accordingly. We're at a similar inflection point with critical metals. The signs are all there. Record prices, supply deficits, government intervention, central bank accumulation, corporate scrambling. The question is whether you're going to recognize what's happening and take action, or whether you're going to wait until it's too late. Let me be clear about something. I'm not saying the sky is falling. I'm not predicting economic collapse. What I'm saying is that we're entering a period of structural change in commodity markets that will have profound implications for inflation, economic growth, and asset prices. And in that environment, the traditional 60-40 portfolio of stocks and bonds may not provide the protection you need. You need to think about hard assets, real things, commodities, precious metals, assets that maintain value when paper currencies lose purchasing power. This isn't speculation. This is risk management. This is understanding the economic forces at play and positioning accordingly. The global metals supply crisis is real. It's happening now, and it's going to reshape markets and economies for years to come. The question is whether you're prepared for what's coming next,